Hello, welcome to our weekly segment of the Cytonn Report. I'm your host, Teresia Kingara. With me on the show today is Justa Kendi, a research analyst at Cytonn Investments. Justa, karibu.
Thank you.
Today we get to focus on the retail report that was recently released by Cytonn. To start us off, Justa, you can give us a bit of a background on the retail report and what it is you are hoping to achieve.
Kenya Retail Sector Report aims to look at the performance of the key malls across the country, of which we will inform the investors on the current state of the retail sector by looking at the key metrics, that is the rental yields, occupancy rates, demand and supply, and compare the performance in 2017 and 2018. In 2018, the market recovered, recording 0.3% points increase in rental yields from 8.3% recorded in 2017 to 8.6% recorded in 2018.
What led to the recovery of the market?
From our analysis, we looked at the key factors that has led to the improved performance. That is mainly recovery of the market from the prolonged electioneering period. Other things are the prudent methods that the investors employed or developers in those malls to attract retailers, such as looking for key international retailers as anchor tenants to improve on the footfall in malls. The other one is increased purchasing power, where we have seen the GDP per capita growing at 7.9% per annum over the last 5 years. And the other one is expansion of international retailers into the country. Over the last 6 years, we have seen over 20 international retailers coming into the country, which is mainly driven by the increase in middle class that are looking for that are embracing more international brands.
You've talked about a decline in the performance of retail in Nairobi. Does that mean that the market is down, or are there opportunities that you foresee when it comes to Nairobi and environs?
For Nairobi, as I stated, we recorded a rental yield of 9.4%, which is a decline. However, there are some markets that are still performing well. Looking at, for example, Westlands, Kilimani and Karen, they are outperforming other nodes, recording a rental yield of 12.4%, 11.8% and 10.8% respectively. This we mainly attributed to the fact that these nodes, they host high net worth individuals or the high-end neighborhoods, so with high purchasing power, and investors are willing to pay higher rental charges for malls in those places, therefore recording high occupancy rates. Currently, opportunities are outside Nairobi. For example, markets in Mount Kenya region, they are recording a rental yield of 9.9%, while Kisumu is also recording 9.7%. As you can see, these are markets that are really above the market average at 8.6%. What is driving the performance, for example, in Mount Kenya region, is the undersupply in mall space, so they are recording high occupancy rates. While for Kisumu, it's more of the increased retail activities trying to serve the urban population, with Kisumu being consisting of 56% of its population urbanized, comparing to Kenya, where we have an average urban population at 26%. Looking at our analysis, we look for an investment opportunity based on the performance, that is the rental yield, the retail space demand, and the purchasing power. From the three key metrics, where the opportunity lies currently is in Mombasa and Mount Kenya region. We have a positive outlook for the retail sector in Kenya. However, we expect reduced activities in Nairobi due to the mall space oversupply. And we expect to see investors shifting to county headquarters in regions such as Mombasa and Mount Kenya that have retail space demand, or a gap of approximately 0.3 million square feet and 0.2 million square feet respectively. And these areas are still recording high rental yields. For example, Mombasa is recording 8.3% and Mount Kenya region is recording a rental yield of 9.9%.
Thank you, Justa. There you have it. The opportunity in the retail sector in Kenya lies in Mombasa and Mount Kenya. Until next time, kwaheri.